everybody. So I am Axel Pierru and from KAPSARC in Saudi Arabia, where I am speaking from. And I am honored to chair this session. So we will have three presentations. The first one by Deepak Sharma is privatizing a profit-making national oil company in India, explaining the rationale and the challenges. So the second presentation will be by Krista Halttunen, the future of the oil industry in a well below 2 degrees world, so a company level agent-based simulation. And the third presentation will be how does economic and policy uncertainty affect the crude oil market by Hongjie Zhao. So a couple of engagement rules. So we have a session that can last up to 1 hour and 45 minutes. But since we have only 3 presentations, we can have 20 minutes for each presentation, followed by 10 minutes of Q&A. So what I would suggest is you can start putting your question during the presentation, so in the chat. So the chat will be monitored, so you can put your question. And don't hesitate to put your name and your affiliation also, I mean, if you wish. So now, without further delay, we can start with the first presentation by Deepak Sharma, who is a PhD candidate in energy economics at the Indian Institute of Technology in Bombay. So he's working in the field of operational efficiency, competition and restructuring of the Indian national companies. Previously, he has worked with the Hindustan Petroleum Corporation, and he will show us more about his research work. So the floor is yours, Deepak.
Thank you, Axel. Yeah, I'll now share my screen. I hope my slides are visible.
Yes.
Yes. Yeah.
Thank you. So the topic of my, hello everyone, the topic of my presentation is privatizing a profit-making national oil company in India, exploring the rationale and the challenges. The topic is interesting in respect of India because this is a significant breakthrough because privatizing a national oil company has ignited a lot of public debate in India that why a profitable national oil company needs to be privatized. The proponents of privatization in India suggest that privatizing will induce much needed competition in the marketing segment of the Indian petroleum industry and will also induce efficiency improvements. While the critics of privatization suggest that privatizing a national oil company, India has not done this before, and the record on privatization also has not been that great in India. So that is why they suggest that this is only being done to fulfill fiscal targets. So let me proceed with the presentation. First of all, as India is heavily dependent on oil and gas imports. And if you see on the left panel, the oil and gas consumption in the orange line, if you see, has increased over the last 30-35 years tremendously. But oil production, which is represented by the black line, has not kept pace with it. And as you know, in India, national oil companies have the dominant share in every functional segment of the petroleum industry. So oil production has not matched the consumption. And this has been the case with gas as well. Gas production, gas consumption has also increased, represented by the blue line, but the gas production has again kind of remained stagnant, while refining capacity has matched the oil consumption rate. So India faces a precarious situation of being very heavily dependent on oil and gas, and it exposes itself to oil price volatility tremendously. But not only oil and gas, but even petroleum products. Till a certain point, India was a net petroleum product exporter. Both NOCs, national oil companies, as well as private oil companies exported oil products. But now the situation in the recent years has reversed. Now only private oil companies are net petroleum product exporters, but national oil companies have become net petroleum product importer. And this is due to the large amount of liquefied petroleum gas being imported in India. So the situation is such that the motive of national oil companies ensuring energy security, increasing domestic oil and gas production, reducing the dependence on oil, gas, and petroleum products imports has not really materialized for India. Now, regarding the structure of Indian national oil companies, basically on the left panel, you have the number of national oil companies all across the world. These are the countries that have national oil companies that host national oil companies. As you will see, most of the countries have single national oil companies in their country. But India, China, and Russia stand unique in the respect that they have multiple national oil companies. It's not one national oil company that's present. And even between India, China, and Russia, India has a fragmented structure of national oil companies. So in the right panel, as you will see, India has national oil company in virtually every functional segment. So until 2018, India did not have a vertically integrated national oil company. It was basically in exploration and production, you had ONGC and Oil India. And then you even had, at one point, you had refining companies, standalone refining companies. Then you had the refining and marketing companies, standalone marketing companies, and gas utility. Over the years, India has reduced the number of national oil companies by merging standalone refining companies with refining and marketing companies and reduced the number of national oil companies. And that till about 2017, you had the two main exploration and production companies, ONGC and Oil. You had the three national oil companies in the refining and marketing segment, and you had the gas utility. So it is BPCL, which is the second largest refining and marketing national oil company in India, that is being privatized. So so the motive of the topic is, what is the rationale and challenges of privatizing a profitable national oil company? As we know, complete privatization of NOCs has only been done in developed countries. For example, be it BP, Total, or Repsol. So there are many NOCs that have been privatized, but those examples basically come from the developed countries. Privatization of NOCs has been largely untested in developing countries. Argentina was an exception because it privatized YPF in the 90s. But as we know, YPF has been renationalized. So we do not have enough cases of successful privatization in the context of developing countries. And for 30 years, India has been trying to restructure its fragmented structure of multiple national oil companies operating in various functional segments. And that is why the complete privatization is a significant breakthrough. We know that academic literature says that in order for privatization to be successful, you need certain pre-necessary conditions, like a well-functioning competitive markets, independent regulation, so that privatization is equitable and efficiency enhancing. But are these preconditions easy to achieve? As we see in the case of India, India has been trying to introduce competition for the last 20 years, and even independent regulation has had its share of challenges. So could privatization be a way to induce competition even before these preconditions are satisfied? So this is some questions that we explore in our paper. So as I said, India had a very fragmented structure. And as we know, exploration and production, you have ONGC and Oil India. In terms of private companies, you have Vedanta and Reliance. In refining, again, you have the three main companies, which is IOCL, BPCL, and HPCL. And basically where we concentrate on in the paper, it's the marketing segment, where there are private companies that are only existent in certain product segments, not in all product segments. So as you know, the automotive lubricant segment, you have a lot of companies operating, which is kind of a competitive market structure. But in the rest of the products, there are very few private companies that operate. Also, if you see the structure of the national oil companies, it's a very closely linked national oil companies because government of India has majority stakes in national oil companies, but even among the national oil companies, you have a lot of cross shareholding between them. So it's a very tightly organized and coordinated uh, structure of national oil companies that operate. And even the financial institution owned by the government of India has minority stakes in leading private oil companies. India has been, after the liberalization of 1992, India has been trying to disinvest from its state-owned enterprises, and it has failed to meet its disinvestment targets regularly. Against the target of 10,97,000 crores disinvestment proceeds, only half of it has been achieved since 1991. But in the last few years, ambitious disinvestment targets have been announced through complete privatization. Until now, most of the privatization were partial privatization or minority equity shareholdings were basically offered in the open market. But complete privatization has been far and few in between. So majority, as I said, majority of the disinvestment target have been achieved through public offers of minority holdings, as well as sales of one state-owned enterprise to another state-owned enterprise. Even in the petroleum sector, most of the disinvestments have come from sales of one NOC to another NOC and sales of minority holdings. That is why this privatization is different. So what about the rationale of privatizing? As I said, competition in the Indian petroleum industry has not increased for the past 30 years. So as you see in the graph, we have computed the Herfindahl-Hirschman index of national oil companies in the marketing segment at the aggregate product level. And as we see that after 1993, the HHI of NOCs has decreased because private imports were allowed and private companies entered the market after 2002. But the decline in HHI lasted for only 2 or 3 years after 2004 because government reversed the deregulation and started re-regulating petrol, diesel, LPG and kerosene prices, which led to the increase in HHI concentration. And that is why you see that HHI, the concentration index is still very high. Even though India has been trying to deregulate, trying to introduce competition, the marketing segment is still heavily concentrated. And one of the reasons for this heavy concentration is the market share stability that has been seen in the marketing segment. Sorry. As you see, IOCL is the largest marketing national oil company in India, and it has the dominant market share. And although it has fallen from 55% in 1993 to 38%, but most of the decline in the market share of IOCL has been due to private companies and imports. And BPCL and HPCL, which are the second and third largest companies, hardly provide a competitive constraint to the Indian National Oil Company. There is hardly any change in the market share of the second and third largest player. So they do not provide any competitive constraint to IOCL. There is also high entry barriers and coordinated expansion of infrastructure. So these three companies, in complete coordination, expand their infrastructure and have the prominent share in the infrastructure. And as you know, that increases the entry barriers. As you see, in refining, 64% is by national oil companies. In pipelines, 100% by national oil companies. Retail station, 93%. LPG distribution, 100%. And even aviation service facility, 86%. So there is really high entry barriers in the marketing segment. And what are the benefits or these are the ideal conditions which we feel that continued price reforms has lessened the burden on national oil companies to administer and compensate for subsidies and under recoveries. As you know, since 2003, India has been subsidizing petrol, diesel, kerosene, LPG, and those have increased. Due to the increase in the international oil prices, the subsidy burden on the Indian national oil companies also increased tremendously. And as we see in the last few years, India has kind of deregulated petroleum product pricing of petrol, diesel, and that is why the under recovery and subsidy has come down. Even the compensation of subsidy has been taken out of NOC's hands and now is in the control of government. The government is now responsible for compensating the national oil companies for any subsidy or under recovery. BPCL has the best financial and operational performance among the Indian NOCs. If we compare the profits and return on invested capital, BPCL has a much higher profits during the period 2005 to 2019, and even higher return on invested capital as compared to peer group as well as the other two NOCs. And also in terms of operational performance, BPCL outperforms HPCL and IOCL. So BPCL is preferably the best company to be privatized because among the two NOCs, other two NOCs, it has the best performance. One of the challenges of privatization is undervaluation of the NOC assets. So we compare the valuation of two other deals that have taken place in the last 2 years. HPCL was sold to ONGC in 2017, and SR Oil Company, a private refining oil company, was sold to a conglomerate of Rosneft and Trafigura in 2018. And as we say that when we compare HPCL and BPCL, the expected value that could be generated out of privatization is estimated to be around 55,000 to 74,000 rupees crore. So when we compare this to HPCL and SR, this range seems appropriate. Only if BPCL is not able to get this amount due to proceeds, privatization proceeds, we could say that there is undervaluation. But this range is supposedly an appropriate range considering the other two deals. One of the fundamental problems that the government will be facing after privatization is the social obligation void. As you know, NOCs also provide social obligation by providing fuels to rural areas as well as subsidized fuels to rural areas, and are responsible to increase penetration of cleaner fuels to rural areas. As you know, India is struggling with energy access issues, and one of the SDG goals is also to provide affordable, reliable, and cleaner source of energy to people. And as you see, after 2014, there has been an increase in LPG consumption in India. And BPCL, again, is responsible for around 25% of fulfilling. The role of BPCL is around 25%. So if BPCL is privatized, a private company cannot be forced to fulfill this social obligation void. So government will face certainly some challenges in slowing down the penetration of LPG. The other challenge is divergence between government stated intent and reality. As you know, government has previously tried introducing competition, has tried deregulating, but it has always backslided on its reform. So as you know, re-regulation of petroleum product pricing after deregulation in 2005. As soon as the international oil prices started rising, the government started re-regulating product pricing. That kind of led to exit of private companies from the marketing segment. Then the ad hoc intervention in pricing petrol and diesel still continues in India. Even after 2018, when the prices have been deregulated, still government intervenes ad hocly for its political purpose, which kind of leads to imbalance in the market and loss of confidence of the private companies. Even creating Hindustan Petroleum as a subsidiary of ONGC. So when HPCL was acquired by ONGC, it was thought that this would lead to a creation of a integrated national company, which has not been the case. HPCL is a subsidiary of ONGC and operates almost as a separate entity. No international major oil and gas company has shown interest in acquiring BPCL. This is due to the fear of energy transition and acquiring assets that that will have a lot of scope 3 emissions. So why would a international major would be interested in acquiring BPCL? So not an efficient oil and gas company is going to acquire BPCL. So that is again one of the concerns. So finally, we would like to conclude that privatized BPCL, when it is privatized, will not suffer the infrastructural disadvantage. As you know, competition has not been introduced in India even after numerous attempts. And maybe privatization of BPCL will lead to certain level of competition because the ownership will change, and BPCL will not be forced to indulge in the stabilization process that was prevalent before. So there are chances that the performance of BPCL would increase after privatization. Also, it would induce much needed competition and value addition in the marketing segment. Of course, the main challenges for the government will be slowing the growth of LPG penetration in the rural economy, which was one of the social obligation which was fulfilled by national oil companies, and removal of BPCL from this will lead to the slow in growth of LPG, which is very important that it is not slowed. Also, the main challenge is that even if BPCL is privatized, the concentration will still be very high. And that is why independent regulation will still be needed to create and maintain competitive markets post-privatization. Thank you.
Thank you very much, Deepak, for this very interesting and informative presentation. I mean, I'm not seeing any question in the chat right now, but I have a few questions for you, if you don't mind. And the other speakers also, of course, can ask questions if they wish, because I think it's very interesting to debate about. I mean, India, the issue of the privatization of the oil national company in India. And so my question, I have a first question that is around what I think is slide 7, where you show the growth in the various players, and you use the term coordinated.
Yeah.
So coordinated expansion of infrastructure. I think it is coming just after this slide. Yeah, this
Yes.
one. When you use the term coordinated, it almost implies that you are saying that there is a kind of collusion. You know, it's not coincidental. So maybe you can say a little bit more about this. I mean, are you implying that they are acting almost together because they want to create entry barriers, or is it just purely coincidental and they just follow each of them their own dynamics?
No, it cannot be coincidental simply because it is coordinated. Because if you see the share of, I have not shown the time trend of addition of infrastructure, but if you see the time trend, even the time trend, you will see that if IOCL adds 50 retail outlets, BPCL will add 25, HPCL will add 25. So the ratio has always been the same for the last 20 years. And that is why you see that there is hardly any standard deviation. If you see in the retail station share, you will hardly see any standard deviation, which means that they act in a coordinated manner. It is sort of a collusion, but it is not written anywhere. But
okay.
Yes.
No, that's very interesting. Thank you. I'm seeing Krista also has a question, so but I will just go through my own question and then Krista, so that we it will be quick. I mean, you talk about when on your slide on financial performance, you mention a group of peers as a kind of control group. I mean, the value for this group of peers seem to be, especially for the standard deviation, quite different. How do you, what does it exactly represent, and how do you compute this peer group? I mean,
yeah, so the peer group has been calculated from the Platts 250 energy companies ranking. So Platts ranks energy companies, the top 250 companies. So they classify companies according to their segment in which they operate. So the peer group has been considered from the refining and marketing group. So there are about 30 to 32 companies that form part of the peer group. So I have computed the mean of profits for the period 2005 to 2019 and their standard deviation. As you know, many of the refining and marketing companies also suffer losses. So that is why many times their profits are also negative. So that is why the standard deviation is really high for the peer group. Yes, in terms of India, India has never allowed national oil companies to be at a loss. It has always ensured that NOCs are profitable. So that is why the standard deviation is quite less for Indian national oil companies.
Thank you very much, Deepak. I will leave Krista.
Oh, thank you. Thanks for the talk. That was very interesting. I actually want to ask about something you mentioned towards the end. So you mentioned this tension between energy access and decarbonization goals, and also how international oil companies might be hesitant to acquire a national oil company because of the risk in decarbonization. So I was wondering, like, how do you think these considerations might affect the future of India and the national oil companies in India, and like, what would actually be a better setup from the perspective of if there's really strong climate change action, so national or privatized companies, and kind of any other thoughts on this, because I don't really know much about the situation in India specifically.
Yeah. So regarding energy access, so even after BPCL is privatized, it's not as if the NOC structure has been dismantled. NOC still will be the dominant segment. It's just that 25% has been 25% share has been sucked out. Now, BPCL being privatized, mostly an Indian player is interested in them. So regarding climate change considerations, again, national oil companies, they are moving towards it in terms of biofuels and reducing imports in terms of ethanol, biofuels, biomass conversion. But I think for the near future, national oil companies still are going to open up refineries in India. So there is plan to open refineries. In terms of climate change goals, at least till now, none of the Indian nationalized companies have taken any targets as such. And it will be really difficult because to ensure energy access, you need to, I mean, after a long time, energy access has been enabled for people in rural areas through LPG penetration. As I showed, after 2014, it has increased tremendously. Now, everything to be dependent on renewable electricity will be difficult. I mean, if you want everything to be based on renewable electricity. So that is why I think for the near medium term, I think national oil companies would be still involved in oil and gas. A lot. Yeah. Thank you.
I don't see any other questions. So I have a last question, I mean, for you, Deepak. And it's more an open one, and you alluded to this, but if you have like a 2-minute answer. So India, I mean, every country is specific, but India is a very large country. It has a huge population. We have seen the growth in oil consumption. I mean, current and, as you say, forthcoming. So how do you think that, I mean, what specificities in India, as I say, like the growth in oil consumption, so it's a growing market, the level of regulation, this kind of thing. How does it interact, or what do we learn from the literature regarding the conditions for benefiting from privatizing national oil companies? So in a situation like India, what are, you think, the important factors? So you alluded to some of them, market concentration, but for instance, the growth in oil consumption, how in oil products, how does it impact the value of privatizing or not? I mean, are there other factors, and what do we learn from the literature? I mean, it's a very large question, so just don't feel obliged to answer comprehensively, but just a couple of thoughts will suffice.
Yeah. So as I understand, few conditions that literature says that are needed before privatization is a well-functioning competitive market as well as independent regulation. So both of these factors have not been ensured in India. but they have been trying to ensure that for the past 20 years. So again, the question arises that if these conditions cannot be met in a developing country, I mean, ensuring well-functioning competitive markets has not been achieved in many developed countries as well in the oil segment, except for US, Canada, or a few other countries. Not everywhere well-functioning competitive markets are available. And even independent regulation becomes a problem, because if you have national oil company, independent regulation again becomes very difficult. So for me, I think the government has to have a long-term view and needs to ensure that once privatization is done, it's done with the purpose of introducing competition. And introducing competition needs to satisfy certain conditions. There should be price reforms, there should be competitive neutrality, there should be, the number of players has to be increased, which has not happened in case of India. So these are all the things that need to happen in order for privatization to succeed.
Thank you. Thank you very much, Deepak, for the presentation and also your thoughtful answers. So now we will switch to the next presentation by Krista Halttunen, who is a multidisciplinary energy and climate change PhD researcher at the Center for Environmental Policy at the Imperial College London. So research mainly focuses on the potential pathways of the global oil and gas sector in the low carbon energy transition. And she will now show some of her research in this field. The floor is yours, Krista. Thank you.
Thank you. Just the mandatory awkwardness of trying to share my screen. Hope you can see that. Okay, excellent.
Yes.
Thanks. So thank you very much. Greetings from surprisingly sunny London. Really excited to be here and hear from people from different places in the world and different areas. My name is Krista Halttunen, and I'm going to talk about the future of the oil industry in a well below 2 degrees world. And this well below 2 degrees refers to a world in which we meet the goals of the Paris Agreement and keep global warming at a level where the average global temperature rise is under 2 degrees above pre-industrial temperatures. And more specifically, I'm going to introduce a new agent-based simulation model of the upstream oil market, which we're working on. This is quite topical at the moment. For example, the International Energy Agency recently published a report in which they quite controversially said that if we are to meet the goals of the Paris Agreement, no new oil production or no investment in new production is needed basically anymore after this year. The work I'm going to present is to some extent still work in progress, so any comments or questions you have will be extremely valuable. And if anything's really unclear during the presentation, feel free to ask, but otherwise I'd prefer to have the discussion at the end. So before we begin, here's just a quick agenda for the short talk. So I'm going to introduce the topic, discuss the method, so mostly the modeling and the data that we've used, some preliminary results, and then I'm going to conclude. So first of all, to introduce, so the motivation for this work comes from a wish to combine 2 different areas of knowledge, so oil market economics, and then also studying the policy pathways of climate change mitigation. And this slide is a very simple illustration. So we know that until today, the use of oil for energy has been very crucial for our development and growth and thriving in modern societies. We also know from climate science that this has led to some unfortunate externalities, specifically, for example, large carbon dioxide emissions that are causing climate change, and also bring along the prospect of disastrous climate change. Recent years have seen a rise in the interest in trying to limit these CO2 concentrations in the atmosphere and the risk of climate change. And obviously, the Paris Agreement of 2015 is a landmark example of governments coming together and, at least in words, saying that they want to commit to reducing this climate change. And in terms of the oil industry, of course, it's not really clear what this emission reduction will actually mean or how it might happen. But for example, we might start with mass electrification of transport and other areas, for example, in Europe. But the big question that I'm interested in, rather than how, is that what does it actually mean for oil if we do somehow manage to meet these targets? So if we do as a society manage to mitigate against climate change, so is, for example, demand for oil going to go down at some point in the quite near future? And what would that look like from the perspective of the industry? And I definitely don't claim to have any answers to this, but I want to introduce some tools for exploring this theme. So hence the aim of this work is to explore what it might mean for companies, specifically in the upstream oil sector, if efforts to decarbonize our energy system will lead to a longer-term decline in our use and demand for oil. The purpose of the modeling is not to try to predict the future, but rather get a sense of what kinds of pathways and outcomes are possible under certain conditions. We especially wanted to see if we could use some simple principles of agent-based modeling to observe how outcomes might differ between different types of companies, and also incorporate an element of decision-making under uncertainty rather than just optimization, just to see what kind of things might follow if investors and companies make investment decisions and the beliefs that they follow in those decisions turn out not to be true. And finally, our aim has been to construct this model of the upstream oil market in a way that is relatively simple, as much as possible, and make use of any publicly available data, which is, of course, a bit sparse in the case of the global oil industry. I will now quickly talk about the structure of the model that we're working on and the data that we've used. So on a high level, the upstream oil market model consists of three main things. So we have exogenous demand for oil from a scenario. It's a future-looking model. We have an operations module, which is about the day-to-day market operations in the upstream oil market, so supply and demand. And then we have the investment decision module, where oil companies, the agents in the model, decide, based on the oil price trends that they see, whether and how much they want to invest in further oil production. The model, of course, makes a number of simplifications. For example, we assume only one type of oil and oil price, for simplicity. This doesn't include any storage of oil. And also, we basically assume perfectly competitive day-to-day market for oil, which has definitely not always been the case in reality. I will talk a bit about each of these modules. So first of all, the operations module. This is just the day-to-day oil market, or actually we're running it just on a monthly basis, just a bit lower granularity. And it's just a tool for balancing crude oil demand and supply. So as I said, demand comes from an exogenous scenario, and the supply curve is then derived bottom-up from data on oil-producing assets, so kind of reserves and production costs and capacities in oil fields. And these assets are owned and operated by oil companies in the model. And the market quite simply just calculates an average oil price for each month by balancing supply and demand, again, assuming that all oil is more or less interchangeable with each other. A word about these demand scenarios that feed into this model. So the scenarios that we've used for these first runs are both from the International Energy Agency. So we have the new policy scenario, the top one, which is basically a stand-in for a business as usual growing oil demand scenario, moderately growing oil demand scenario. And then we have the sustainable development scenario, which is an example of decreasing oil demand, the orange one. We've added just some monthly random variation to these values to at least somehow replicate the small changes that happen in the oil market all the time, not even attempting to replicate any big events such as a pandemic coming out. As you can see, these scenarios are already a bit dated now, because we are obviously now in 2021, so we could also just replace the 2020 values with what actually happened. And we are going to do this, but this is just an illustration of what these scenarios look like. And these two types of scenarios are used and to compare the outcomes for companies under different oil demand futures. We're focusing on the period until 2040, mostly because of data availability and scenario availability. Not many people dare to predict much further than that. And to then quickly talk about the second module of the market model. So this is the day-to-day market, and this is the investment decision module that operates after the day-to-day market in each of these cycles. So this is a bit more tricky to explain, but here each company decides how to invest their cash each year. And for simplicity, the way this is structured is that we have the company agent, and each of them has a set of decision rules, and they also have have a pipeline of undeveloped assets that they have access to, as well as an option to invest in expanding their existing production capacity in the fields that they already operate. The decision to invest is made for each asset following a real options type logic. So the decision depends on the level of the oil price at the time of the investment decision, which comes from the market module. Actually looks at the average oil price over the past year rather than just a snapshot of the price. It also depends on the break-even costs of the assets in their pipeline and their own assets. So it doesn't make sense to invest in assets that won't make money given the oil price levels at the time. It also depends on what we call strategic risk attitudes, or more simply, just how much higher the oil price or the expected oil price needs to be than the break-even cost of these assets in order for the companies to invest. And finally, depends on if there is any limit to how much a company can invest or expand their production each year, which there is just because of kind of physical constraints. And this might be especially important if we want to study companies restricting their output, like historically sometimes some OPEC producers have done. Estimating the values for these parameters is of course quite tricky, and there's not too much literature on this. So far we've just used quite simple top-down calibration methods, but we're hoping to expand on this, for example, with discussions with stakeholders. What's really important at this point is that these decision processes are held constant over the two scenarios. So we basically want to see how the outcomes in the high demand world and the low demand world differ if people are making investment decisions following the same kind of logic in both of these worlds. Finally, a word about the data. So there's of course very, very good detailed data on oil supply out there, but hardly any of it is publicly available. And as part of this work, we wanted to see like what we could do to start producing something that could be potentially open source or kind of accessible to more people. So we started quite painstakingly going through different kinds of data points on production costs, for example, and then trying to just match them to production levels and reserves in different countries and different fields to build up a data set that's not exactly representative of the real world oil supply, but on a high level it matches the supply curves that we see in literature. So there's one of these versions is on the left-hand side graph. This is also still in need of some calibration, but we have the break-even cost and the marginal costs. And they basically end up meeting at the end because both become so steep towards the end of the supply curve that the difference becomes very small or looks very small. And given this bottom-up data set of oil supply, we've also then allocated these assets to oil companies. At this stage, this is done more or less at random, except for some exceptions. So for some countries, for example, we have taken all the assets in a country and allocated them to the single company to make a single national oil company. On the right-hand side, there's an example of this allocation right now in terms of reserves, where we pretend that there's only 18 upstream oil companies in the world. The highest bar actually corresponds to a company that supposedly combines most of the Middle Eastern oil assets. So rather than splitting it, although we can also split it up into the individual countries, with the exception of Saudi Arabia, which is the company number one. So the second highest bar would be Saudi Aramco, for example. And then for the assets that didn't fall into these quite neat categories, it's allocated pretty much at random for the international oil companies. Of course, this could be done in more detail just by going through the asset ownership of different companies, etc. But at this stage, haven't done that level of detailed work yet. Now to quickly look at some preliminary results of this work so far, again, preliminary. So a word about calibration first. So it's not necessarily easy to calibrate something that's very exploratory and future looking, also when the situation changes all the time. So we can construct the supply curve, but then obviously the supply curve will keep changing every year as oil is used up and companies make new investments. But one thing we did is that we compared the average oil price outputs of the model to projections of the International Energy Agency. Here's the current state of the comparison, the business as usual on the left and the low oil demand on the right. It's quite clear from this that the orange bar, which is the IEA's projection of future oil price, is clearly higher than what our model is giving at the moment. This could be because of the assumptions of perfect competition in the market in our model, which might lead to more low-cost production or something else. At least the differences between the two scenarios are somewhat consistent. So always we get higher prices in the business as usual rather than the low oil demand scenarios. So then just to give some flavor of the types of results, even though they are still preliminary. So this one just zooms into the price difference. So average oil price difference between the business as usual and low demand scenarios. We can see that the price levels diverge more over time, although there's some exceptions in the middle of the time period. And that, of course, seems to be a straightforward result of the demand levels diverging more and more over time as well. One thing that's quite interesting to look at and something that hasn't been done very much before is to think about the profits and investments that companies have and how these might differ under different scenarios. The model gives these for individual companies, or at the moment, the dummy companies that we're currently using. But here we have aggregated it to national and international oil companies for simplicity. The graphs show percentage differences between business as usual and low demand scenarios for profits at the top and investment at the bottom. So one thing you can see from comparing the top and bottom row is that the profits tend to actually decline a bit faster than the investments in these scenarios. And also the international oil companies actually stop investing in oil earlier, although there is this one freak year in 2027, which might be because of the reserve cost. So on average, the international oil companies have more expensive oil, but both types of investment go towards zero at the end of the, so basically in the low demand scenario. So the percentage difference between business as usual and low demand is 100%. Another kind of result we'd be interested in, so tracking reserve development. There's a big disclaimer here, is that our model doesn't have any exploration in it. So we're only tracking reserves that were proven or probable in 2019. So this picture shows how much of those reserves remain in the two scenarios for national oil companies at the top and international oil companies at the bottom. And the difference between the scenarios are actually not huge, which is quite interesting. So it basically means that in both scenarios, there's still quite a lot of oil that we have today still will exist in 2040. So for example, if we think about risks of asset stranding, that exists in both scenarios, although obviously depending on how future oil demand will develop. And final bit of results, so we wanted to think about how the market shares of different companies might develop. So this is again a very crude example of just the international and national oil companies and this is the international oil companies' market share in terms of production in the two scenarios. And the key thing here is that in the low demand scenario, the market share in 2040 is only half of what it is in the business as usual scenario. Of course, we might hear a question, does it actually make sense that the market share of the international oil companies is falling so much, even in the business as usual scenario? That might not be what actually happens in the real world. And that question depends on behavioral assumptions about how we think different companies might behave in the future. So here again, we're assuming this free market, kind of lowest cost reserves first type logic, although with some constraints year on year on production expansion. So kind of laws of economics basically lead to more low cost oil coming from relatively cheap to produce regions, kind of taking over more of the market. We are going to take this analysis further to see how the different assumptions of OPEC's strategy will affect this output. So basically, does this difference between these scenarios remain, even if we think that OPEC would restrict their output in the future to maintain a higher price level, for example? There's definitely a lot of more discussion that could be had, but I will start concluding here to have space for any comments. So again, clearly this is work in progress, but we still believe that this could be quite valuable in the longer term. So to recap, I've presented a new model of the upstream oil industry, which is capable of simulating the behavior and tracking the financial outcomes of individual oil companies. And kind of the key result that we're looking at is how oil demand and the extent to which oil companies anticipate changes to oil demand can really affect their investments and their ability to make money and compete in the market. And of course, many open questions and potential improvements and extensions to the model remain, many of which I've already mentioned during the presentation. Then the final takeaway I want to leave you with is that if we go back to this high-level problem I proposed at the start of the presentation, which is basically what happens to the oil industry, given that we do want to mitigate climate change, it seems quite clear that a lot more work still needs to be done to understand the range of possible pathways, regardless of if we're going to meet the Paris Agreement targets or not, just given all this discussion about the energy transition. And when the future is so uncertain, sometimes stepping back to do some real exploration and looking at the big picture, even on a high level, can be quite important. Thank you very much for listening. I look forward to any questions and comments.
Thank you very much, Krista, for this interesting presentation. So I will start using my privilege as a chair with a couple of questions. So first, I would be interested, but maybe it's not an easy answer in a short time, but to understand how your model, at least under the assumption of a competitive market, how your model would produce results which would be different from a standard optimization approach. And you said at some point, you talk about optimization, but you know that you can use optimization under uncertainty, and you can use a forward-looking assumption, you can use adaptive assumption. So how do you think that, or what do you think that your model or the approach you are choosing here, what is captured by this approach that will not be captured by a more standard approach of optimization under uncertainty with stochastic scenario and things like that? And second, if you can, maybe if it is possible to clarify a little bit, so you talked a little bit about this, but can you say again how you model the attitude in risk? So where is the uncertainty, where the agents make decisions? So when you have a company making decision, what kind of uncertainty they take into account? Where do they see the uncertainty? And third, I think you already answered about it, but the national oil company, they might have some strategic behavior. As you say, this is left for future research, if I understand. They might have also some constraint, like the importance of oil in the national budget and the need to produce a certain level of revenue to just finance, the services which are essential for a number of countries that depend on oil. So that's something that could also maybe be embedded in the model at some point. But I let you comment or try. I mean, don't feel obliged to answer thoroughly to my question, but just because we have time limitation, but just what you think you could say in a short period of time. Thank you.
Of course. No, very good questions. Thank you very much. And it's also very useful for us to hear what kind of reactions this quite preliminary work gives people. So the difference from standard optimization under uncertainty, hard to say at this point. This is also in some ways an experiment. So there's not so much of this kind of agent-based modeling done in the space of oil markets, as far as we are aware. And it could be that it gives quite similar results, which would also be interesting to see, or it could be that we find something that the optimization models can't capture. So this is my kind of non-committal answer at this stage. But we anyway think that it's interesting just to try new approaches and also introduce new techniques, even if they might be a bit crude at the start. So the next question you asked is about this attitude to risk and how companies take into account uncertainty. So the main uncertainty is, of course, that there's no knowledge about the future in the model. So the company agents, they don't know how the demand for oil or the oil price is going to develop. So all they have is historical developments, and that's what they base their decisions on. So, and I mean, this is quite a simple type of uncertainty in a way. But the idea is that, for example, if the oil price is going to go down in the future, but you rather assume that it's going to be like it has been historically, the decisions that you make in terms of investment might not be appropriate for that. So that's the main uncertainty in the model. And the risk attitude that I mentioned is basically about just how willing companies are to invest, given the if the oil price is not that high. So, for example, do you actually believe that the oil price will go up in the future? This may or may not be relevant anymore. I mean, people are being more and more cautious with their investments, but it's kind of a simple tool for exploring how these kinds of things might affect the outcomes for investors. And finally, yeah, this point about national oil companies having some constraints on their production and the need for the cash to keep their national budgets running, that's of course a very important point. My question is basically, how do we know what this is going to be looking like in the future? So this is, again, very speculative work about what would happen if we did actually manage to meet the Paris Agreement targets. If we did, it's quite clear that there will be less oil used and sold in the market unless we come up with some incredible emissions reducing technology very quickly. And at some point, this question of kind of peak oil demand is going to become more and more important. So basically, what happens if we don't actually use all the oil that we have and all these resources? And it's actually quite hard to see what countries that have very large reserves should do in this situation. So does it make sense to kind of try to still keep the price high, or does it make more sense to try to monetize your reserves that you have as soon as possible? So the behavior might also change in the future. But I completely agree that this would be very interesting to build in and maybe compare kind of different possible futures. Of course, you get then quite a lot of layers of different uncertainty, but as an exploration, it might still be interesting.
Thank you very much, Krista. I don't see any other question. I mean, if I'm checking. So, Deepak, would you have a question? Yeah. Because I see you appearing. Yeah. Okay, please go ahead.
Yeah. My question was regarding the production cost. Many companies that you might have considered in your sample have production activities in various countries. So do you aggregate the production costs, or how do you estimate the production costs?
Yeah, this is quite tricky. So actually the way we did it is that we want to think of it in terms of assets rather than companies. So that's why you need these two layers of entities in the model. So we, rather than looking at Shell, we look at kind of different countries and different oil fields for which you can derive some very crude average costs. And then you make some assumption of like, okay, how many assets does a specific company have in different countries? So again, unless we go into massive amounts of detail to really do this realistically, it's quite high level. So, and that's why the discussion I presented so far was more about these differences between national and international oil companies. In the future, it would be interesting to maybe take a few companies who are quite transparent with their data, and then for those ones, really put in the right numbers and see what happens.
And where do you obtain the country level, asset level data from publicly? Is it available publicly?
Not really. So this has been part of the project. So basically just finding any data points that you can from different publications, different articles, even news articles. We are intending to eventually publish the data set we have created, but with the knowledge that it's not meant to be exactly right. It's more like giving the direction of travel. Because again, I think it's quite a barrier to research that there is so much data out there, but most of it is completely inaccessible to people with normal sized budgets.
Yeah. Thank you.
Yeah, I'm not seeing any other questions, so I have a last question for you, Krista. On the slide where you show the percentage variation in the price, you have a kind of outlier, so it's not a statistical outlier because it's the result of your simulation, but in 2000, I think 35. Can we see the slide? So what
Yes.
is happening? I mean, it's there is an ups and downs. I mean, in a very short time, it seems.
This one.
Yeah, here, yeah, the one in 2035. So
Yeah, it's true. It's so the model is inherently quite chaotic or it easily leads to chaotic behavior because of the way it operates. So if price kind of goes up a little bit, and suddenly there might be tons of investment, and then the market is operating there's a much more oil in the market, or then vice versa. And then here, of course, it's the difference between the two scenarios. So any kind of differences might be amplified. You have kind of two somewhat chaotic processes. So again, this should be really smoothed out by running the model over and over and over again, the simulation, rather than just having an example scenario like I'm showing here.
okay, I see. So yeah, it's a particular simulation here. It's not.
Yeah, exactly.
I think okay. So okay, thank you very much, Krista. So
thank you.
I'm not seeing any more questions. So now I suggest we go to the presentation by Zhao. So Mr. Hongjie Zhao is a PhD student in economics at the University of Aberdeen, and he's working on the information uncertainty and oil price and policy, and he will tell us more. So I leave you the floor, Zhao. Thank you.
Yeah. Thank you, Chair. Let me share the screen. Okay. Okay. So good morning, everyone from cloudy Aberdeen. So my topic is how does the economic and policy uncertainty affect the crude oil market? So the motivations. So uncertainty is a huge concern for the economy. Typical examples like the 9/11 terrorism event, the financial crisis in 2008, and also some other speakers, they talk about the uncertainty in the oil market. So it will deter the consumption, investment, and the hiring of new employees and so on. Thus, it will put pressure on the whole economy. And the oil market is a crucial commodity market and a financial market, which is very sensitive to the macroeconomy and the uncertainty information particularly. And so in this study, I want to investigate how is the crude oil market affected by the uncertainty informations. So literature review. So Baker used newspapers articles to construct an uncertainty index. So in this study, I use a lot of uncertainty indexes from this method. And also Hurado use econometric method to capture the difference between a prediction and a reality, which reflects the uncertainty. And I also use 3 indexes from this method also. And literature review on oil market. Killian, in his influential paper on oil price shocks, he disentangles the oil price shock to 3 components: crude oil supply shock, aggregate demand shock for the whole macroeconomy, and also the precautionary demand shock for oil market. And he thinks that in recent years, precautionary demand is more important than the direct oil supply shocks. And this kind of shock is triggered by uncertainty about the future in many events like wars and the Iranian revolution. And Yang finds oil price shocks have little effect on economic policy uncertainty, but are significantly influenced by it. And Kang finds that oil price shocks explain 41% of the variation in economic policy uncertainty. And the data, as we all know, it is very difficult to measure uncertainty precisely. So in this paper, I use 10 different uncertainty indexes to compare each other. And also the oil market, I use oil price, oil rig, and oil inventory to represent the whole oil market. They are from EIA website. So oil rig represents the explorative activity in the oil market. Other than oil production in the current literature, oil rig can follow closely to the change in uncertainty information. That is one of the new contributions of this research. These are the 10 uncertainty indexes. The first two are US economic and policy uncertainty. And also we have financial stress indicator, geopolitical risk index. And also we have the global economic policy uncertainty at the purchasing power parity level and the current price level. And we have the China economic and policy uncertainty because China is the biggest importer of the oil in the market now. And also we have three econometric based uncertainty index, real uncertainty, macro uncertainty, and financial uncertainty. And this is a picture from the Baker. We can see that the peaks in the uncertainty index are correlated with many events, like I said before, 9/11, and also the Lehman Brothers collapse, and also the Gulf War. Yeah, and this is a monthly global economic policy uncertainty. We can see in the COVID-19, the period, the uncertainty index, the global uncertainty index achieves the highest level. And these are the oil price, oil rig, and the oil inventory data. So the methodology, I use the standard vector autoregressive method. The dependent variables are oil price, oil inventory, oil rig, and one uncertainty index. And the granular causality, impulse response, and variance decomposition analysis are also used to interpret the result. Finally, I use the Diebold and Yilmaz spillover index to interpret the spillover effect and the connectedness among the variables. So again, the preliminary results. In all 11 models, I find oil price, granular causes oil rig, and oil inventory significantly. Oil price has relatively big impact on the crude oil rotary rigs in operation and the inventory level. And also oil price granular causes US news-based, US rig components, global economic policy uncertainty at the current price and purchasing power parity level, and the financial uncertainty and the macro uncertainty significantly, which indicates oil price is one source of uncertainty. And the 6 uncertainty indexes granular cause oil price, the financial stress indicator, macro uncertainty, real uncertainty, US rig components, geopolitical risk indicator, and the financial uncertainty. And the oil inventory granular causes 4 uncertainty indexes, US news-based, US 3 components, and the global economic policy uncertainty at 2 different price levels. And for the model, I can show some models, some graphs with single uncertainty index. This one is with the US news-based uncertainty index. We can see from the right hand side that the oil price can explain like 40% of the variance in the oil rig. Again, it shows that the oil price has a relatively big impact on the oil rig level. And also oil price can explain like 20% of the variance in oil inventory. And here the oil price can explain like 10% of the variance in the US news based uncertainty index. And for the impulse response, we can find that US news based uncertainty index is at first is a negative shock to the oil price, and later it changes to positive, and finally it becomes insignificant. And and also oil price is a negative shock at the first like 12 months for the USA news-based uncertainty index. For the global economic policy uncertainty, again, in this graph we can see that oil price can explain like 50% variance in the oil rig. This is higher than itself, and also it can explain like a little bit more than 20% of the variance in oil inventory. And also it shows a negative shock to oil price, and oil price is a negative shock to the global economic policy uncertainty at first, but just at the first 3 months, and then later it changes to positive. And for the China economic and policy uncertainty, Similar results like the oil price can explain like 40% of variance in oil rig and 20% of the variance in oil inventory. But here we can find that the oil price and oil rig and oil inventory can explain very little in the variance of China economic and policy uncertainty. And again, China uncertainty information is at first it is positive shock to the oil price, which is different from the U.S. Economic and policy uncertainty. But here we can find that the oil price is still negative at first, but the level is very small. And for the Diebold and yield mass spillover index, we find that the overall spillover index is like 76.4%, which is quite high. So we can conclude that in this model, the variables are connected very significantly. And for the contributions to others, the biggest one is the GPR, the Global Geopolitical Risk Index. And the second one is the USA News based uncertainty index. And the third one is the oil price. So these three are the biggest contributor to others. It means they contribute to the variance of other variables. And for the first three biggest receivers of uncertainty or information are global economic policy uncertainty at PPP and current. And the third one is China economic and policy uncertainty. So these three are the biggest receiver of the information from other variables. Okay, and to conclude that overall the connection between uncertainty and oil market is significant, but varies by different uncertainty indexes. The overall connection is 76.4% from connectedness table. The biggest contributors to others are geopolitical risk index, USA news-based, and oil price. The biggest receivers from others are global economic policy uncertainty at the current and PPP price level, and China economic and policy uncertainty. And the uncertainty information is a negative shock to oil price in the short term. Later it becomes positive. And there is a strong relationship among oil price, oil rig, and oil inventory, which indicates that the oil market is quite integrated. And China EPU is a positive shock to oil price at first. So after 4 months, it becomes negative. So USA oil inventory responses positively to China economic and policy uncertainty. However, China economic and policy uncertainty can only explain few changes or variance in oil market. That is my presentation. Thank you for listening. If you have some questions, you can ask.
Thank you very much, Zhao, for this interesting presentation. I mean, I do have a couple of questions. I have actually, first, I would be interested to know more about the broad context of your research. I mean, what has motivated you to look at this? I mean, was there a specific question, you know, initially? And my follow-up question is, beyond the nice technical results, how would you frame these results to policymakers or to people to decision makers, to see how they can use them? Because I think there is potential to be used, but how someone, I mean, I don't know, working for governments or in the industry, I'm just thinking loud to see the practical also aspect of this. And I'm also interested to coming back on the slide about the economic policy uncertainty, the index, and how they define uncertainty information. So because it's new to me, I think I understand the context, the principle. Yeah, that one. Thank you. So my understanding is they select a number of newspapers, they look at the combination of some keywords like uncertain, uncertainty, economy, and some other words, and they count the number of articles, and they see when you have a peak or in this number of articles that include this combination of words, then it shows that people are, I don't know, worried, questioning the future. So there is uncertainty. So is it the principle?
Yeah, that is the principle. So for your last question, you are very right. So they try to capture the different keywords in the newspapers. So and then they it makes some sense because when you are uncertain about the future, so you want to search or you want to for the authors for the newspaper, they write something about the uncertainty in the newspapers, and then when it is a high uncertain period, so the uncertainty information in the newspaper will be high also. So it is correlated. Yeah, so that is a principle. And for your first question, because after the financial crisis, I think we all worry about the uncertainty in the macroeconomy, especially after this COVID-19. It is the biggest uncertainty event in our time period, actually. So I want to know the uncertainty information. How does it affect the oil market? Because according to the efficient market hypothesis, that all the public information should be reflected in the oil price, and because oil market is quite important in the economy, so I want to find the relationship. And many researchers, they try to find like the gold price and maybe stock price and like other variables. They try to find the relationship between oil market and the different financial market. So that is my motivation and my motivation to do this study. And I think for your second question, for the policymakers and for the investors, they should because it gives them a new perspective to see the oil market. Previously, they maybe see the oil demand, the oil supply, the basic fundamental information in the oil market. But now they can look at the uncertainty information. And I think it helps them to predict the future oil price, or maybe to make the policies to stabilize the uncertainty, and then it will give a stable economic growth or stable development in the oil market. Yeah, that's it.
Yeah, thank you very much. Yeah, the usual topic that usually, I mean, economists must look at are the sources of volatility in the oil market, so of price volatility, and disentangling the supply, the effect of supply shocks from the effect of demand shocks. And you are mentioning some of this literature in your slides. Yeah. And also the impact on the volatility of the oil price on the global economy. So that's typically, you mentioned this, these two topics in your slide. So thank you very much for the insightful answers. So do we have any other question, including from the other speaker? I mean, if someone wants to ask a question, he can go through the chat or switch on her or his video if she or he is a speaker. Okay, so I'm not seeing any additional questions. So I just so it's 11:40, so we are 20 minutes in advance. But knowing that many sessions had 4 presenters and we had 3, I think we all the presenters did a very good job, and I would like to thank you all of you for this. And I suggest that now we can leave the session and attend later all the other session of this very interesting conference. So thank you very much. I see that the session host has appeared. You have a statement or something that you would like to make?
Exactly. First of all, thank you all for your presentations. It was very interesting to hear about all these things. Because for me, it's not, my studies are not related to any of energy studies or oil or gas or all of these. I just want to add in the end that please, like, if you have not uploaded your slides or presentations to the dashboards, please do as soon as possible. That would be beneficial for us, just like to have a record of everything that's happening. And that's it. Thank you so much, and best of luck in the upcoming meetings.
Merci beaucoup.
Merci.
Merci à vous. Thank you very much, and see you at the other sessions.
Thank you.
Merci. Au revoir.
Au revoir.
Ciao, ciao.
Bye-bye.